All right, welcome to the Explainer. Today, we're going to do something a little different. We're actually going to crack open an official financial document to really understand a unique kind of investment fund. We'll break down how it works, who it's for, and what all that fine print really means, using the document itself as our guide. So, let's start with something I bet a lot of you have felt. That feeling of stress when you look at the market. I mean, you want your money to grow, right? But let's be real. That day-to-day stock market roller coaster, it can be super stressful. Watching your portfolio's value jump up and down all the time, yeah, that's not for everyone. So what if there was a middle ground? An investment that's designed to find those opportunities in the market's moves, but maybe with a little less drama, a little less volatility. Well, that's exactly where a certain type of investment fund comes into play. All right, let's meet this middle ground option. We're going to look at a real-world example here, the Groww Arbitrage Fund, and we're going to use its own official scheme document as our map. Okay, so what are these things? Well, the core idea behind an arbitrage fund is actually pretty clever. Instead of trying to guess if a stock is going up or down, which is basically predicting the future, these funds try to make money from tiny little price differences on the exact same thing in different markets. It's all about precision, not prediction. And don't just take my word for it. Here it is, straight from the source. The main goal? To generate long-term capital growth by jumping on these arbitrage opportunities between what's called the cash market, where you buy stocks, and the derivative market. Okay, that all sounds great in theory, but how does this whole exploiting tiny price gaps thing actually work? How does it make money? Let's get into the mechanics. Probably the best way to wrap your head around this is with a simple analogy. Imagine a book costs $10 in one store, but right across the street, it's selling for $11. Arbitrage is you running over, buying it for $10, and immediately selling it for $11. Boom, you've just locked in a $1 profit. The fund is just doing that, but with stocks at a massive scale and way, way faster. So here's the playbook. This is the main strategy they use. Step 1, they buy a stock in the regular cash market. Step 2, at the exact same time, they sell a futures contract for that same stock at a slightly higher price. Then they just hold on until those prices meet up, which usually happens when the futures contract expires. And that little difference between the buy and sell price, that's their profit, pretty much locked in. And hey, it's not just a one-trick pony. The fund manager has a whole bag of tricks they can use. They can look for these little pricing quirks around things like company dividends or buybacks. They can even find them between different stock exchanges or play with contracts that have different expiry dates. Lots of tools in the toolbox. Okay, but let's be real. Every investment has risks and, of course, costs. Nothing's free. So let's dive into the fine print and see what the official document has to say about the not-so-fun stuff. First thing you'll see here is the official riskometer. And look at that. The fund's own document labels both the fund and its benchmark as low risk. Now that makes sense, right? Since the whole strategy is about avoiding bets on where the market's headed. All right, let's talk about costs, because this is super important. Every fund has these annual running costs called the total expense ratio, or TER. As you can see from the table, the percentage they charge actually goes down as the fund gets bigger. This fee gets deducted from the fund's assets throughout the year. But hey, there's some good news in that fine print too. The document is really clear. There is no exit load. What does that mean for you? It means you won't get hit with a fee when you decide to take your money out. So, if this whole idea of a lower volatility strategy first approach sounds interesting to you, you're probably wondering, okay, how do I actually get started? Well, the good news is the barrier to entry is super low. The document says the minimum you need to get started, and for any additional investments later on, is just 500 rupees. Now, when you do invest, you've basically got two main paths. If you use a distributor or a broker, you'll get what's called the regular plan. But if you go directly to the fund house yourself, you get the direct plan. And the direct plan usually has lower costs because you're not paying any commissions to a middleman. And to make life easier, the fund offers a bunch of handy tools. You can set up an SIP, which is a systematic investment plan, to invest a fixed amount automatically every month. You can also do systematic transfers or even systematic withdrawals. Super flexible. So, at the end of the day, who is this really for? Well, the document tells us straight up. It's for people who are specifically looking for these kinds of arbitrage opportunities to grow their money over the long term. It's a specific tool for a specific kind of investor. Look, understanding how something like this actually works is always the first step. So the big question now, the one only you can answer, is this. Does this type of strategy, low volatility, focused on these little price gaps, does that actually fit with your personal financial goals and where you want to go on your investment journey?